Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
So, as you know, that we're in a time in real estate where home prices are going crazy, and a lot of people have compared this to the last time this happened. So, what we want to do is we have some very good data here that actually does compare it to the last time. It's very eye-opening data, and we're going to start with the first obvious thing. Okay, Juana. So, last time home prices went up. There was a crash.
Right.
It's a huge market crash, right? Okay. So I think, let's talk about price first. Why do you think the average person is only because that's all they're looking at. They're only looking at the price. That's really all they're looking at.
Because money is sexy.
Okay.
I mean, honestly, money is a sexy thing. It's easy to measure. It's easy to see. It's something that we all touch and feel and transact in every day. So money is something that everybody understands.
Do you think that some of it is because they saw the same numbers last time and they're seeing that again, and they're just taking a simplistic view and saying, well, price went up, crash, price went up, so crash. That's just how it works, right?
Right. I mean, it wasn't even about specific numbers. I think it was just about trends. So they saw this trend of real estate prices increasing at a rapid rate over a relatively short amount of time.
Right.
So that they're just comparing things because this is a natural thing. I mean, we are used to, as people, as humans, to put things into categories, put things into buckets. So people say, okay, price is going up, that's what happened last time. Price is going up, that's what happened this time. Last time it crashed, this time it's going to crash. That is not necessarily the same thing. There are so many more things to consider, but that is the easiest thing to consider. And let's face it, there's so much information out there that is clickbait, whether it's on on the national media front, on legacy media, whether it's on YouTube or whatever media you're on. Look, there's a lot of clickbait. People get paid to get you to watch, okay?
Six figures.
They get paid, or more. And so the more people watch this, the more it's kind of this thing that just feeds on itself, but is not a self-fulfilling prophecy. So I want to be very clear on that. While all of this negative information feeds on itself, it is not a self-fulfilling prophecy because there are so many other things working in this environment that were different in the previous environment.
Okay, let's talk about those. So I'm gonna jump right to the slide that's the most obvious thing, but we're gonna talk about a couple different categories of things that were factors. Okay, so I'm gonna put up the first slide. This is the money shot. Okay, the last housing crash we had, 2007 to 2010, nationwide, we had between 7 and 10 million homes on the market a year, meaning that was supply that was on the market. That doesn't include the vacant houses that were sitting around vacant. This is the supply. That means listed in MLSs across the U.S., which is how it's measured.
So we all know that the more of something that you have, the lower the price for it, because let's face it, at that point you can negotiate, right?
Well, yeah, it's supply and demand.
Yeah.
Okay, so you have the last housing crash when there were 26,000 houses in the MLS in Las Vegas, and when the banks started foreclosing and they wanted their money, they went out to the REO agents like us and said, how much can I get for the house? And we would say, well, there's all these houses just like it listed for $350, and the last comps were sold at $350, but if you want to sell the house, it's going to be $330 or $335 because right now, that's, it's less.
Right. And the thing to keep in mind is that the last time around, the banks wanted to sell their properties faster than the neighbor's property. So it was this whole downward spiral. Yeah. So the idea was, well, if the last house sold for $350, I want to sell mine faster, so I'm going to price it less than that to get action and get it sold. Because what we were told was, what's the value of the property on the open market, and what is the quick sale 30-day value of the property? So of course, if the regular value of the property is $350, the quick sale, is going to be less than that. So there was this whole downward spiral, which I'm kind of intimating was basically kind of like a toilet, and that's what happened with the real estate prices. There was just this race to the bottom.
Okay, so that was actually two things. It was a supply problem, but it was banks just trying to recoup the money as fast as possible.
Right. There was another issue though. So there was all this supply, but on the demand side, there was this issue where people were starting to stop making mortgage payments.
Tactically.
Tactically.
Yeah. What was
right.
that? Strategic default.
Strategic default,
Okay.
right. So people were starting to stop making mortgage payments tactically for strategic default. That means that you decide that, hey, my house isn't worth that much money anymore, so I don't want to pump more money into it, so I'm going to stop making my mortgage payment. Now, what that meant was that these people's credit was negatively affected, so they actually could not go out and get another loan to buy another house. So we have rising supply, and we have diminishing demand because the buyers, Sally and Fred and all these people could not go out and buy homes anymore because their credit was negatively impacted. So so those two things were going on. There were other things going on. Part of the reason why the banks wanted that 30-day value and they wanted to sell that house as quickly as possible was because they needed the cash. So there was a whole liquidity issue at the time. So there were a lot of different things that are different than they are today.
Okay, so we're going to go over all these because these are actually the perfect storm of things. Okay, so you had a lot of properties on the market. You had a relatively disinterested seller from a point of trying to maximize the money. They just need to get cash fast. I'm going to add another one in there. You had an asset manager whose only compensation was how many properties a month he could get under contract and sell. He was just some person who worked at the bank who was trying to get another $2 or $3 grand a month in bonus, who was working with an agent saying, look, if you could sell this house, I can get you a replacement listing as fast as possible. Let's just price it low and sell it. So you had that pushing down the market, okay? You had the buyers, the sellers who were being foreclosed and defaulting. They were tainting the future buyer pool because they couldn't enter the buyer pool. The only people really buying for the most part were investors.
Right.
And were paying with cash.
So to the point that I made earlier, as far as banks needing cash at the time, banks don't need cash today because we have the highest savings rate possible, and our money is where? In the bank. So the banks are not cash poor. They do not need the money. So that is a different variable than last time. So right now we've talked about two things, about two big things. We've talked about a lot of things. So one of the big things that we talked about was the difference in inventory levels. So back then, 8, 9, 10 million homes on the market. Now a couple million homes on the market. Back then, banks needed money. Today, they don't need money. Back then, buyers couldn't borrow money because they were defaulting on existing loans. Today, that's not the case. They've recovered from that. Their credit's gotten better, and they can go ahead and buy properties.
And this is the interesting thing. It's the timing, because those people who defaulted, their credit has just gotten good enough in the last few years.
Right.
So what you have is you have this huge group of people who've all entered the buying pool again because their credit's recovered. They're past that, if they had a short sale or a bankruptcy or something, they got beyond it. Now they're like paper buyers again.
Right.
So they're all flooding back in to buy at the same time they've been saving this whole time. So you have supply side issues that we've talked about that literally don't exist, like none of them exist today. And then you have the demand side issues that none of them exist today. The only thing that's the same is price, the number on it. The price is high. When you look at the last 4 years of the supply of homes on here, the other interesting is the trend. This is dropping. 3.7 million in 2018. Down to 3 million, down to 1.9, 1.8, which is about where we've stayed. Anything under 2 million in the US is ridiculously low number. Oh, one more thing. The loan programs that were happening back then.
Right.
That was a contributing factor that we don't have today.
Right. So
tell them about the loan programs.
So back then, the loan programs were, they were almost cartoon-like, okay?
Yeah.
They were slapstick loan programs because you could borrow money. You could borrow 100% on your first deed of trust, and then you could borrow another 25% on top of that for whatever. So people were buying a home, buying an RV, buying a boat, buying a car, all on the back of a house, right?
Yeah.
So now when you're borrowing 125%, of what the house is worth, that's not going to work. That's not going to end well. That's not a good story. Today, that's not the case. Today, buyers have to have money in the game. They have to put down a good down payment. They have to have savings. They have to have reserves. They're having to come in with cash out of pocket to meet the difference between appraised value and purchase price. We have the highest savings rate, and it's a completely different financial picture for these buyers today than it was back then.
Yeah. This is not anecdotal data. This is like actual, this chart is from National Association of Realtors. The reason why they have a good idea of what the inventory is because they're the ones that collect all the data, meaning they have all the housing data. I don't know, Zillow wouldn't have this because back in 2007, 8, 9, 10, Zillow really didn't have like every listing in the MLS on their platform yet.
No.
Today they would have a better idea, but NAR has these numbers. This
is not something that's in Zillow's interest. This is not their wheelhouse. Their wheelhouse is to get as many eyeballs on their website as possible so that they can grab those people looking and then sell their information to agents, to mortgage people, to whomever, because that's how they make their money. So this sort of data is not in Zillow's wheelhouse. And that's not to disparage Zillow, but this is not what they do. The National Association of Realtors, they're much more focused on data because they understand that data is what gives real estate professionals power to educate their clients. And part of the reason why the National Association of Realtors exists is to make sure that there are professionals out there guiding buyers and sellers and that they're being provided with good information. So I'm not suggesting that we are the end all and be all of your information, but that's part of the reason why this data is coming from this organization. Okay,
I'm going to provide what I call the cherry on top.
Ooh, I like
the
it.
final thing that is going to solidify the fact that when you strip out what we've clearly have shown is we've stripped out all the things from what happened last time to right now that they don't exist. That perfect storm, none of those things exist except for, of course, the number's higher, right? The price is higher. But this cherry on top is the magical thing that actually it's like the icing and everything. It holds the whole thing together.
Okay, wait, before you tell them that.
Yeah.
Okay, if you like the video, subscribe, hit the notification bell, like the video, and leave us comments. Okay, back to you.
Okay, the last time this happened,
yes,
the government spanked the banks because they they said it was you guys that gave these loans, it was you guys that did the foreclosing, and the government came out and said, we need you to fix this, we need you to start giving all these forbearances and deeds in lieu and these other things, and we need you to fix this, okay? It also hurt them because when they started doing this, they actually, when the notes that they had were actually losing value because the real estate market was collapsing. And if they could have gone back and done this again, the market crash wouldn't have been anything like it was. If they had the knowledge, because what they would have done is they would have metered it out over more time. They would have given people workarounds. They just wouldn't have gone off and lopped everybody. Okay,
so to give you a quick example, so think of it this way. Usually when a builder puts down a subdivision, right, they encourage buyers to use their lender, right? So you had these entire subdivisions that were maybe only a couple, 2, 3 lenders in the whole subdivision. So they would have multiple houses on the same street that let's say, Bank A had the loan on 3 out of 5 houses on that street. So when they sold house number 1, then they were beating themselves up on the price for house number 2 and then hurting themselves again on house number 3 because every house that they were selling, they were actually lowering the price. And so they were hurting themselves by getting less money every time they sold a house that they financed. And this went on everywhere. It wasn't just here in Las Vegas, it was everywhere. But that's just a really good example of how the banks just were not thinking as to what they were doing.
Yeah, and there was a specific lender, which was Countrywide, that was in with a lot of builders, and they were in a lot of states like Florida, Georgia, California, Nevada, Texas, Arizona, and Colorado. They were tied in with with a lot of national builders. Is in many cases the exclusive. When you walked in the office, it was a Countrywide. You did your loan with them and the whole thing. And when and they were one of the banks, of course, that they got hammered. Of course, Bank of America eventually came in and bought them to salvage whatever they could out of there. But I was one of the first Countrywide agents, REO agents. I had a Countrywide account like really, really early here in Vegas, and it was fascinating because literally when I first got the account, there was a limit of 20 properties. That's all you could have. You could only have 20, and I got it in like a week. Like they filled me up in a week, and then I didn't get any more listings from them. But I had to sell. I had to get stuff sold to get. And it was exact, like if I had it, I think they had like a backup. They didn't have enough people because there were some days that I would get it in the middle of the day because it closed that morning. And as soon as it showed in there, like the asset manager hit a button, said it's closed, it would go, oh, give Todd another one. And it would just do that. So you don't have that today. I mean, remember that last crash was really driven by new home building, which was crazy. New home building was a blown up thing. It was artificial, something we actually didn't talk about. It was artificial because of the lending and the cheapness of construction. I mean, it was cheap, it was inexpensive. They didn't build cheap houses, it was inexpensive to build. Lending was super easy. Cocktail waitress could get a loan and buy 5 houses.
Stop picking on the cocktail waitress.
I'm just using that as an example because it's clear the cocktail waitress doesn't make enough money to just go out and buy 5 $400,000 houses in Las Vegas. But they just get stated low income. Oh yeah, sure, I make that. You
just like cocktail waitresses, we know.
Or whatever. You could pick anybody. Guy that 20-year-old that does oil changes could go buy 5 houses. And the builders saw this demand and they rushed in and started putting a ton of resources. They were buying land. They just sort of accelerated the whole thing. That the opposite is happening now. We don't have. You would think. Now you would say, wait a minute, Todd. If demand is really strong and supply is really low, then we're disequilibrium. It's an economic word, right? Economics. Then you would say, well, then the builders, they should be rushing in because they can't. This is why they can't get the land. They don't have the labor. And they don't have the supply chain.
And they got burned last time.
They're being and we all know that some builders are building subdivisions and keeping them. So they're not being sold. And we also know some hedge funds in New York and Wall Street are buying entire subdivisions.
Well, but this time around, builders are very careful because they are afraid that they're going to get caught again with a bunch of inventory that they can't unload, and that's going to hurt them. The other thing is the uncertainty regarding pricing and availability for labor, for materials. So that's all playing into their equation. But I think the biggest thing that's playing into their equation, I honestly think it's just that they have this PTSD as far as what happened to them last time, that they are being very cautious this time around, and they are not saying, you know what, we're going to commit to building this huge subdivision and we're going to sell all these houses and it'll be great. They're not doing that.
If the market was going to crash from what's happening right now, it probably would have done it in 2020 when COVID first hit and all these homes were in forbearance. We just did a video on that. All these homes in forbearance, and that they're gone. They're not in forbearance. We're back to a completely normal market. We have another video, which is just our county here, Las Vegas, essentially, where we show foreclosure and pre-foreclosure activity is literally zero. It's effectively, when you have one foreclosure a day, and I mean only Monday through Friday and not counting holidays, like 20 a month in a market where there's nearly 500,000 houses and you have 20 a month, that's zero. That doesn't affect the market. That's zero. It's nothing. Might as well be none, because there were 60 a day being foreclosed back then.
Right.
There's literally nothing. If you look at the last crash, the collapse, I would call it, and right now, there's literally nothing's the same except for prices went up. Oh, they went up 15 or 25% or 30%. And I think we've explained this like a ton of times. I still think it's fascinating though. And first of all, if you're still watching, we appreciate it, because a lot of times people like bail after 7 minutes to go, I don't agree, and they leave, right? So maybe you agree.
Well, and if you don't agree, leave us, comments and, support your disagreement with with data, because we're always interested in data. Clearly, we do like to look things up and find out what's going on. So if you have information to share with us, please do, because we want to know what you think, and we want to know what data you have that maybe we haven't considered.
And what's interesting is I have had some people that have commented snarkily in the comments about, well, I can't. Well, it's unaffordable for me, and I can't make ends meet and stuff like that. And no, we feel for you. We get it. It's kind of, there's some people out there just that are having a difficult time because inflation is killing them. They don't have the wage growth maybe. Their stuff, the groceries, everything costs more. And to them, this is even, all they can think of is, wait, this is a mess for me. Like personally for me, if I was saving for a house, you're done. You can forget it. It's like going to be really hard to do right now. But what you don't realize is that in aggregate, which is when you take everybody, there's tons of people out there with tons of money. And how we know this is, first of all, they're buying all the houses. But second of all, when we have a listing and the agent sends us, their loan approval and then proof of funds, and we see that, even though they are only putting $80,000 down, they send us a bank statement that says they have $200,000 in a savings account. They have money. So there's a ton of people that have money. So for them to do this, to hedge inflation, do whatever. So sometimes people just look at themselves and they go, I don't understand. So because I don't understand, or they just watch too many videos saying it was going to crash. And I've watched the videos, and it's fascinating because they have no facts. There's literally no facts other than made up stuff, or there's no data. Look, we're just looking at the data.
Right. But look, everybody's situation is different. So our discussion here is based on data. It's based on numbers. It's not based on individuals, because everybody's situation is different.
Yeah, and we're not pushing anyone to buy. We're not pumping the market. We would be thrilled if the market crashed and all the banks came back and said, guys, we need you to list all these bank-owned properties. We sold 3,000 houses during the last downturn. We'd love to do that again over the next couple of years, but it's not going to happen. None of our asset managers, they all went back to being real estate agents and took other jobs. None of them work for those companies. Most of those companies don't exist anymore. The banks aren't going to foreclose like they did before. There's almost nothing that would cause this. There's almost nothing that would cause the inventory to rise enough for prices to fall. Now, that doesn't mean that we think this is going to go on forever. Certainly don't think it can. But it's kind of, Wall Street, there's a lot of smart people on Wall Street, and they look at these numbers. And when Wall Street came out a couple years ago and started buying like crazy, and they did at the bottom of the market, BlackRock was the big one. They were the first ones in Vegas. They completely wiped out the trustee sale. They came and they said, hey, this is crazy ridiculous. Home Affordability Index, the last video we did, the highest it's ever been. They just said, we're buying houses. And they bought hundreds of thousands of houses across the U.S., which is still a small percentage, but they started buying them. They're looking at this and they see some long-term trend, and I don't think they care about a downturn or prices declining or whatever. And I think, honestly, most people don't believe it's going to crash, and this is why. If they did, they would be selling. They would be doing the math going, wait, I'll just sell my house and then wait a couple years and buy another house when it's, and I think they're afraid. I think they're like, yeah, but what if it doesn't go down? What if I sell my house and then I can't buy in a couple years? Now I become a renter, potentially forever.
Right. And there are those people who earlier, within the last year or so, sold their home because prices went up and it was a good time to sell. And some of them are happy they did, and some wish that they had held on to their houses a little bit longer. Look, none of us have a crystal ball, and we don't know. We can't time the market. But what we do know is that right now inventory levels are at record lows, and that the whole environment is completely different than it was back then. Right now there's a lot of support for these values, and we don't see these values declining anytime soon. Will they decline at some point? Sure, everything does. But when they decline and to what point is something that none of us know.
Yeah.
Look, if you like the video, please subscribe, hit the notification bell. We appreciate the comments, and we'll see you on the next video. Bye.
Bye.